On the Tape is presented by CME Group, where risk meets opportunity. iConnections, reimagining how the investment industry connects, and SoFi. Get your money right all in one app.
Welcome to the Monday edition of the On the Tape podcast. I am Dan Nathan, as always joined by Guy Adami, and of course, EY from SoFi. That would be Liz Young. Hi, guys.
What
Hello.
up?
We got a big show here. We had a big week last week. The three of us were down at iConnections Global Alts Conference in Miami. We are actually, as the B block of this fine podcast, are going to post an interview that Liz moderated with Mike Wilson and David Zervos. Mike Wilson of Morgan Stanley. He is the head strategist. There was some news around him, and we're going to talk about that in a second a little bit. And David Zervos is the head strategist over there at Jefferies. We're going to cover that really hot jobs report on Friday. We're going to cover a bit of the tech earnings that saw just some of these names absolutely blow out Friday during the trading day, and probably a few other things here on this fine pod. First, a little housekeeping. I was down in Washington, D.C. Guy, I was at your alma mater. That would be the Georgetown Hoyas. And one, Liz Young's alma mater, I think you got your MBA at Marquette. The Golden Eagles of Marquette really took it to the Hoyas on Saturday afternoon in D.C. Liz, thoughts there? Because this team is kind of rolling as we head into like Big East play here.
You know, it used to be that Marquette was like the darling of the Big East, and we were so good for so long. And then there was a period of time there where nothing really happened for a while. So it's nice to be back. And not just my MBA. My mom also went to Marquette. I was baptized on Marquette's campus. So MU runs deep over here, and I'm rooting for them all the way.
Listen, big fan of Marquette. My roommate got married at Marquette. He's from, as I've mentioned a number of times, Mequon, Wisconsin, which is a suburb. And of course, when I was a lad in the 70s, Marquette with the Al McGuire reign was the team to beat for a long time. So there used to be a saying amongst the bookies around tournament time, put your bet on Marquette.
Oh,
Like
see,
that.
it rhymes for a reason.
Yeah.
Yeah,
You know what's interesting? I grew up obviously in Syracuse, New York, so I was a Big East basketball fan, through and through. Georgetown was the nemesis of Syracuse back in the 80s. And it's interesting to see, Syracuse joined, I think about 10 years ago, the ACC. The Big East basketball, though, if you think about it, Georgetown, in my opinion, on the rise, but Marquette, Creighton, UConn, number one in the country, Villanova, they won a few championships over the last 10 years or so. So I think the Big East is on its way back. All right, let's talk about someone else who's on his way back, and this is a dear friend of Guy Christopher Adami's. That would be Jay Powell. He was, had a bang up presser on Wednesday afternoon. Liz was on the market call with us right before that. She was on the set of Closing Bell right after that. The market was a bit volatile on Wednesday afternoon. It took the message loud and clear that a March rate cut was likely off the table, pushing it out to May. That's what Fed Futures, the CME Fed Funds tracker, was kind of immediately pricing that. I think right now it's about an 80% chance of a cut. But last night on CBS's 60 Minutes, Fed Chair Powell, he made it kind of clear that, March is clearly off the table. We see yields up a little bit. We see SPOOs down just a little bit, 30 basis points, but we see the 10-year at 4.12. Guy, I know you didn't listen or watch, but you watched a few headlines. I'm going to go to Liz. Liz, what changed in Fed Chair Powell's commentary from Wednesday afternoon and what we heard in the press by some other Fed speakers and last night? Now, granted, that interview was recorded on Thursday on his 71st birthday, guys. So you and him, you're pretty similar in age there. But Liz, what changed? What changed, at least as we walk in Monday morning, as we're recording this right before the opening, to see yields up where they are and maybe S&P down a little bit?
Really, I think the only difference was that in the presser on Wednesday, he just mentioned it one time and he was very clear that we may not be confident enough by March. The conversation that was aired last night was just digging deeper into the details of why and pushing again, almost doubling down on it and saying, yes, I meant what I said on Wednesday about we're not going to be confident by March. So I think what's happened now is that the market finally is believing him. I think for a long time, frankly, and even through the end of last year, the market wasn't listening. We weren't listening to what the Fed had been saying throughout most of this hiking cycle. And we got excited, the market got excited about cuts coming sooner, and I know that we've warned about that a lot. Be careful what you wish for. You don't actually want them to come sooner. And I had said for a while, I think they're gonna get pushed back, not just because I don't want them to come sooner, but I think they're gonna get pushed back because there's not a good justification to do it yet. So, here's the thing, March or May, does it really matter? Probably not, not unless something happens in the meantime. Now it's looking like maybe even June is the first one, and what that does to the market, so what's changed now, which hasn't necessarily priced into the market yet, but what that does to the market is, as we know, that period between the last hike and the first cut, the market tends to hold up okay. If we keep pushing that first cut back, we may just sort of trudge along in this middling ground for a while, unless there's a reason to find more upside, which at this level of valuations, I don't find a good reason for.
I was going to say I actually did watch it, believe it or not, because I felt I was compelled to do so. But I like Scott Pelley. He's obviously not it from our world, but I thought he did a good job. But he pushed them on Silicon Valley Bank, and effectively Jerome Powell said, "Yeah, we whiffed. We, the Federal Reserve, whiffed on that without question. We've sort of tightened things up a bit." He doesn't think this latest New York Community Bank thing is systemic. He thinks they're banks that are probably going to sort of get rolled up and stuff, but he doesn't see any concern there, which I totally get. One of the things that I found really interesting, because people always think this is the case, Scott Pelley asked him about an election year and you're going to feel pressure on the political front. And he basically said, integrity is something that, you want to maintain and you can't really put a price tag on it. And I actually believe him. So for those that think these rate cuts are on the back of some political pressure, I don't think that's the case. I just think the timing is such that makes a lot of sense. But to Elizabeth's point, it's when they start cutting is when you should be concerned. And quite frankly, whether it is March, May, whatever the meetings line up, I don't necessarily think that makes a difference. But I'll say this as well. Danny has talked about this. Once they go, they're going to go in a meaningful way. Like they're not going to stop. And it's going to be interesting to see what happens to the inflationary inputs that really haven't abated all that much.
So one of the things I would quickly just add to that, I think even we're not going to start in March. I was never really on the side of thinking that we were going to start in March, but I think there will be at least one larger than 25 basis point cut this year. Maybe not in reaction to something bad, but I think that we see at least a 50. And remember, we tend to forget this. When we started that hiking cycle, there were 4 75 basis point hikes in a row, and those were bookended on either side by 250s. So we went up fast and we went up hard. They can come down. They have the room to come down a little bit faster.
Yeah, and I guess the issue here is that, what I'm starting to rethink here a little bit, a year after being fairly well convinced that the economy was due for a recession because the pace in which hikes were going to happen in 2023, and then when you threw in the Silicon Valley Bank sort of thing, to me, I've gotten a lot wrong over the last year. And now what I think about is this. I see, and I agree with Guy, I think what Fed Chair Powell, he made one mistake. In 2021, they were just a little late to the inflation game, okay? And we spent a lot of time debating what the word transitory meant, right? And so if they had kind of maybe rejiggered things a little bit, but it might not have mattered because as we got into 2022, that whole curveball with Russia invading Ukraine and the disruption with crude oil and natural gas and further disruption with supply chains, that's not something that was on too many folks' bingo cards, especially in 2021 when we saw, inflation starting to boom. But when I think about this, we have an S&P very near 5,000. We spent a lot of time in Q4 of last year debating all these strategists and their targets and stuff like that. 5,000 was lots of their targets, right? Well, here we are. And we're going to talk about some of these tech earnings. We've been spending a lot of time talking about how the top 6 stocks saw on average about 50% year-over-year EPS growth in Q4, while the bottom 494 in the S&P saw down 10%. Something unnatural is happening right now, okay? And we saw it in the stock market on Friday with Meta up 20%, with Amazon up 8%, that sort of thing. Some of these other stocks getting back on their horses. Listen, guys, NVIDIA is up 40% in a month. It has a $1.65 trillion market cap. It has gained $650 billion in market cap in the last month without a shred of news, okay? So I worry I worry that something very unnatural is happening in the stock market. But let's go back to the economy for a second, okay? Fed Chair Powell seemed kind of calm. When guys like Guy believe that the whole integrity bit about the election year and what he might not do, right, for the perception of helping the existing administration and the like. And the other headline last week was that former President Trump said if he is reelected, he is not going to reappoint Fed Chair Powell, the guy that he did appoint back in 2017. I just want to make one point here, and I know you guys know this. Inflation has come down. They're not going to wait till their 2% target, okay? Wages are steady, okay? And let's hope that they don't go too far too fast, because that would be, the reinflation, like discussion here. But we had that unemployment jobs, data that was super hot. We have a GDP that's running hotter than expected. Maybe this economy is just fine. Maybe it is different as far as the economy is concerned, and maybe that's what the stock market is telling me. And I know that was a bit of a rant, but Guy, like something is happening. There's a huge disconnect between the stock market and the economy if you're looking at the stock market as a monolith. But if you're going back and looking at it the way we like to parse it out, and the things that I've been wrong about for the last year, okay, then it might be dangerous.
Lot to unravel there. So first of all, in terms of the people with their bingo cards, fortunately, most people that play bingo are not in charge of the Federal Reserve. And I'm no genius, but in terms of Russia, Ukraine, which you mentioned, a lot of people couldn't foresee that. Well, that's not entirely true, because we talked about it months prior to the fact when the Russians had 100,000 troops basically massing up on the Ukraine border. They weren't there to sort of sun themselves. So if you were following along, it should have been pretty clear that something was going to happen. So I don't give them a pass on that necessarily, but I think your point is well taken. In terms of the economy, yeah, I mean, as long as people continue to spend, which they clearly are, they do have jobs, which they clearly do vis-a-vis the unemployment rate, the economy is going to sort of chug along. I mean, my concern has been around consumer debt. I think the average credit card rate now is 21.47% with credit card debt north of $1 trillion. Also, I think there's close to $9 trillion of government debt that needs to be sort of funded at some point over the next year or so. It's going to be interesting to see who buys that as well, especially with what's going on in China. So as much as there is to like about the stock market, without question, there's so many things to be concerned about on the macro level, I think. Still, by the way, none of these things have gotten better. Some of them have gotten worse.
So, and I don't want to spend too much time on this, but I'm going to do it anyway because I already started the sentence about Powell. If we go back to Dan, you said he seemed calm. I think that's just his general affect. I think he's always kind of calm. I've seen him act maybe a little irritated at times in the sense of the market isn't listening, you guys aren't listening, these questions in the presser are redundant. I've seen him get a little irritated about that, but I think he's always going to seem calm even in the middle of a crisis. And as far as the political piece goes, the way that I think about it for him is he more interested in protecting his own reputation, or is he more interested in protecting the reputation and the integrity of the Federal Reserve? I'm going to err on the latter, right? I think he's trying to protect the Federal Reserve and just the institution. And there has been a lot of discussion about whether or not the credibility is still there. And I think it probably is important to him to restore the credibility of the Federal Reserve much more than it is for him to expect to get renominated. And frankly, we don't even know that he would want that job again, right? I mean, he's been in the seat for a while and it's been a rough few years. So I don't even know that he would really want that role again.
Yeah, listen, agreed, and I agree on the integrity bit. I think it is about the institution. I think we've had plenty of guests over the last few months talking about that he does not want to be the guy who fell asleep at the wheel while inflation re-inflated, right? And then it became ingrained in the economy. And so there were a couple pressers, I think, over the last year where we felt like he didn't really have a great handle on, some of these sorts of things, or at least the way he was articulating it to the audience. Again, we could debate that until we're blue in the face. I just think that there's stuff going on in the economy that has not gone on, or at least the way that we have perceived it, through the lens of the markets, as long as I've been in the business, because so many economists, so many strategists were wrong about the economy over the last year. And Guy, I didn't mean to say, I know that you were all over, like you were saying, well, inflation inflation will only get worse at a time where a lot of folks were thinking it was going to tamp down. People forget the stock market, the S&P was making new all-time highs the first week of January of 2022. So that leads me to this Mike Wilson headline. Okay, so Mike is the chief strategist at Morgan Stanley. Mike has come on our podcast, I think almost every quarter, guys, since we started maybe 3 years ago. Mike and I go way back since he was a tech specialist at Morgan Stanley in the late 90s. I consider him a great friend. I consider him one of the smartest market minds that I know. I also think he's a really, when you think about humility in this business, I think many of us, that we can't find too many people who have it. You know what I mean? He's had it, guy. I know you've known Mike for an awful long time. The headline on Friday afternoon was that he's stepping down from some, the CIO's committees, maintaining his strategist position. You and I have made the point, guy, that on many occasions, while he maintained his bearish stance all of 2023, and a lot of people were throwing their arms up and this and that, whatever, he was one of the first strategists to get bearish as we were heading into 2022. So most of those strategists never changed their tune throughout the entire bear market in 2022, okay? So a lot of folks were like, that's it, like that was the headline, you know what I mean? Sell stocks and this and that, whatever. I guess I tweeted something, and I've not tweeted in 6 months or so, and I don't generally look at the messages or whatever people are responding to. Man, I use the term cheap sheets. I said cheap seats. I said something like, those in the cheap seats, and I didn't mean like those who don't get it or this. I meant the anonymous trolls on Twitter. Like people were dunking on them all over the place, okay? And I just made this point to, on many pods over the last few months since Mike was on with us a couple months ago. Man, his customers voted him II number one just a couple months ago. The people that pay Morgan Stanley, that pays his salary, the only firm the guy has worked at in 30 years on the street, okay? So guys, speak to me a little bit about that for those people who want to dunk on a guy like that, who is obviously very well respected from his peers, okay, and obviously his clients, and what that means, because people are always looking for capitulatory sort of things to kind of say, that's it.
So it's interesting. I mean, I'll make a sports analogy. It's great to be voted into the All-Star game by the fans. And, that's an honor, obviously, because you play for the fans. But to a certain extent, that becomes a popularity contest. I think the rewards and the awards that professional athletes and people in our world hold the most dear is when your peers acknowledge your work. And that's, to your point, exactly what's going on with Mike Wilson for a number of different years. Yeah, so it's easy to sit at 30,000 feet and say Mike Wilson's been bearish for 3 years. The market's going up straight for 3 years. He's wrong. He got squeezed out. Morgan Stanley's kicking him out. None of those things are necessarily true. The reality is the guy does extraordinarily thoughtful work. He put himself out there. Elizabeth interviewed him. I'm sure she has some comments as well. I think he'd be the first to acknowledge that this has lasted a lot longer than he thought it would, but nothing necessarily has changed. I mean, what he is seeing is consistent with very late cycle stuff that we've seen historically. So we'll see how it plays out. But I have the utmost admiration for him. And the fact that people in our world acknowledge him over and over again, I think speaks volumes.
As a fellow strategist, I would consider myself not necessarily a peer because he's in just an upper echelon of that realm. But as a strategist, number one of the things that I have always respected about Mike and continue to respect about Mike is his intellectual consistency and his intellectual honesty, even in the face of disagreement, and his ability to portray that still in a confident yet humble way and just say, my research, my work is still showing me that this is what the take is, this is what my take is, and I'm sticking to it because I can't prove the other side with intellectual honesty. And I've always really respected that about him. The reality of it is, no matter how much people want to attack and assume that they know exactly why this happened, how it happened, and whose decision it was, nobody does know that. We don't know that. Mike probably knows that, and that's about it, right? And maybe some people at Morgan Stanley. Who knows what the cause was? Perhaps it was something that had been a long time coming. Perhaps it was something that he even wanted, right? So it's easy to make assumptions. It's easy to assume that it's something bad and a big juicy story because that makes better headlines. But also, he wasn't wrong in 2022. He was right in 2022, and lest we forget all of the bulls in 2022 who were wrong. And what if something like this would have happened to one of the bulls in January or February of 2023? It would be the same vitriol. It would be the same commentary. just flipped in the other sentiment direction.
Yeah, we talk about not making the same mistakes over and over again, and I don't know, Liz, I don't know, I don't think you were in the markets back in the post.com crash and the ensuing bear market that lasted 2000, 2001, 2002, three consecutive down years. I don't think we had that in the markets, guys, since 73, 74. I think that was a sort of thing. And I have a little PTSD from that period, but it's remarkable that, as horrible as the financial crisis was and what it did to risk assets with banks going under and insurance, it was just devastation. The S&P was only down 1 year, so the idea that the markets go down 2 consecutive years, I thought that was going to be the case in 2023, or at least the first half. And that was also became consensus, I think, about a lot of market strategists and differentiating between being a market strategist and an economist and then a fund manager, so that's what I got wrong. And I think Mike probably suffered a little bit from what Guy and I have suffered in 2023, is that we weren't really given a great opportunity to get out of our bearish market call. Not a whole heck of a lot has changed as some of the underpinnings of the things that worry us about the economy. But now here's where I want to go to, and maybe we can just end on this, guys, and spend a few minutes on this. Is like, I just alluded to it. What's happened in NVIDIA? What happened on Friday with Meta? Meta gained $200 billion in market cap like that. Listen, it feels like we have entered a blow-off phase, okay? It feels like those last couple months before the March 2000 high in the NASDAQ. It feels like those months after Bear Stearns went under in March of '08, and then the market felt like it was just all tidy and contained because JP Morgan and the Fed had done the job, right? And then we went up, I think, 15% in the S&P 500 before the S&P got cut in half, right, over the next year or so. I worry that what's going on right now, that maybe some of the things that going on in the economy, maybe I don't understand, maybe a lot of economists don't understand, a lot of folks who are looking at it, interpreting it through the lens of the market don't understand, but I worry that maybe the economy can keep chugging along in this new kind of found order that we have, but something horribly wrong is going to go in the stock market because the concentration guy is getting that much more acute, and to me, that much more dangerous.
Yeah, well, we thought that this was going to be the year that you broaden out the rally, and it looked for a period of time like that might be the case. And the reality is we've just fallen right back into that same, I don't want to say trap, but basically into that same sort of vertical in terms of 10 stocks dominating the entire thing. But, in terms of the economy, I'll just throw this out here real quick because I think it's worth mentioning. Elizabeth knows about this as well. S&P 500 all-time high. NASDAQ, basically, all these things are making all-time high. The individual stocks we can rattle off. The Russell would need to rally 26% from here in order for it to reach the prior all-time high that it made. So the small caps clearly are telling a story that maybe I don't completely understand. But when you're talking about the most economically sensitive names out there, theoretically, an economy that everybody tells me is doing so well, with interest rates going from at 1.5% in the 10-year down to 380 and now hovering around, 415 or so, one would think that the small caps would have gotten on their horse, and they have not for whatever reason, understanding that they're predominantly led by small and mid-sized banks, which leads me to New York Community Bank, which, again, people think is, again, basically specific to them, which I probably would agree. But you think New York Community Bank's the only bank out there with problems, and they have $100 billion in assets. So they're not necessarily a small bank. I mean, it's a rather significant bank. So I think there's more pain on that front. I'm concerned that the Russell does not participate, understanding the banks are a big component of it. But I think it's important to point that out.
Something else, if you look at what happened in the Russell in late 2021, there was this big rally. It had a breakout. People got really excited about it and said, "That's it. That's the signal. Bull market continues. Bull market, new bull market, right?" And now we're just off to the races. And then after that, it fell apart. So just because it might have had a tiny little breakout, right? It did bust a little bit, like a few points above that resistance line. That doesn't mean that you declare victory. And again, I am one of the biggest small cap bulls usually. I love talking about small caps, but I love talking about them because they are so indicative of what's going on in other parts of the market and in the economy itself. And remembering that small caps employ at least half, if not closer to 60% of all employees in America. So they matter so much, not just to the market, but to the labor market and what's happening with all of capital markets. What you need from small caps, and we've talked about this in the last couple of weeks, you need it from small caps and you need it from industrials. You need both of those to confirm, not lead necessarily, but you need them to confirm that we are in an expansionary phase of the market and of the economy. That has not happened for small caps. Industrials have seen a nice run. Uh, Small caps, however, have not yet confirmed that. And the last thing I'll say about this, to Guy's point, small and mid caps are typically dominated by banks. And in a period where we're still worried about regional banks, whether or not that becomes a bigger problem or not, usually on the other side of a contraction, on the other side of a recession, you see something like small cap value, mid cap value outperform, because if it is a financial crisis, those are the ones that lead coming out. So this is probably not the time to be piling into it and assuming that they're going to do better, especially when we have a huge question mark about what's going to happen with regionals.
It's interesting because, regional banks, the KRE, the ETF that tracks them, is down 26% from year ago levels. And we know that in March, obviously, we had the SVB meltdown and they went from, I think the KRE was like in the mid 60s and it got as low as maybe the mid 30s or so. So here we are, we're back in the high 40s, but again, been very volatile, well below those year ago level highs. BKX is still down 15%. So if you're looking, like to your point about the broadening out, you're pointing about small caps and the concentration around financials and how the Russell 2000 trades. It just doesn't trade well. And I'm looking at my screens because the market just opened here. What do I see that's raging again? I see, semiconductors. I mean, look at what's gone in NVIDIA. NVIDIA is up today. We are 15 minutes into trading or 10 minutes in trading. I don't know, 3.5%. It gapped up 3.5%. This is a $1.65 trillion market cap company that is set to report in 3 weeks. Okay. This is, I know I'm getting a little hopped up here. This is really dangerous because, again, there's just a handful of stocks and we keep losing some of them. Look how bad Tesla trades. Tesla gapped down 2%. And the point here is that when the story's over, and we've been talking about the Tesla story for the last year, the fundamentals have been telling you that the story's over. People didn't want to believe it for a good part of last year until they started to. And so I just say, if you pull forward all of this enthusiasm about a Microsoft, about an NVIDIA, about a Meta, about an Amazon. Even Google did not trade well after this. If you start seeing some kinks in the armor, guy, you know what I mean? You start losing these stocks one by one, it's going to start to steamroll or snowball or whatever you want to do. And that's how the S&P is quickly down 10% on its way to down 20%. And I do believe this year we're going to have a 20% drawdown.
Well, the NVIDIA, you mentioned NVIDIA, it's worth mentioning. AMD, which reported while we were in Miami, and the quarter was okay, I guess. I didn't think the guidance was particularly good. And I think the fact that the stock doubled effectively from last quarter suggested that it had a huge bar to jump over. I don't think it did it. But with that said, here we are basically unchanged from when they reported. So there are a lot of things out there that I look at and I find myself scratching my head. But to your point, they're the have and the have nots right now. I'll give you an example today for Caterpillar making a new all-time high. The flip side of the coin, McDonald's seemingly potentially could put in a bit of a double top here. That's lower on the day. So, again, there's stuff for the bulls out there. There's stuff for the bears. I'm looking at the Russell down again. I'm also looking at a VIX. It's been north of 14, for a little bit now, which I think is telling as well. Friday, the VIX had a, pretty solid day given the fact that the market was up. So maybe the VIX is telling a story as well. There are a lot of things to look at here, and we'll continue to do our best to try to sort of break it all down.
Before you come in, I just want to say this because guys mentioning the VIX here, that's kind of ticking up a little bit. There's a weird thing happening in the options market right now, especially among these much loved names. The skew, and I'm just going to leave this really simple. The price that you would pay for upside calls versus downside puts is leaning towards the calls. Calls are becoming more expensive. Usually it's puts, right? People want protection for their things. And when you see that start to happen, your antennas better start getting up. And I had a friend of mine, a very successful money manager, tech manager, hedge fund manager, also runs long only money. Okay. He told me on Friday that 70% of his hedge fund portfolio is in NVIDIA, Meta, and Amazon. Okay. So he is having a bang up year. And you know what I said to him? Please collar those stocks. What does that mean? Selling an upside call, taking in the premium, having some room to the upside where that stock can continue to go between now and that expiration and that call price. And if the stock goes through that call price on expiration, your stock would be called away, but you're going to use that premium to buy a downside put, okay? To put in a floor in which you would lose on that. And famously, Mark Cuban is a billionaire because his company that would have failed miserably. This is broadcast.com that Yahoo bought, I think in 1999, and he was given a boatload of Yahoo stock, became one of the biggest stocks in the entire stock market, okay? He took that stock and he collared it and he said, you know what? I'm good. If this stock goes up to that call strike price, I'm taken out, and that's my trade, but I want to defend that position below a certain point. And that's why he was able to buy the Mavericks. That's why he's on Shark Tank. That's why he's the guy who he is. I'm telling you right now, the market is giving you the Mark Cuban opportunity to protect some of these fabulous gains, especially in the options market. Liz, do you think about some of those kind of disconnects and that are not things that most investors have their eyes on? But to me, I think the market's giving you a very good opportunity to do that right now.
Yeah, so I think that's actually what I could be wrong about this, but I think that's what made Mark Cuban a billionaire. I think that's when he ticked above a billion. And in that moment, it would be really easy to get irrationally exuberant and say, I'm invincible, money will always be there, I'm a billionaire, it can't go down, right? But he didn't, and he still practiced risk management. I would say this, something much less prescriptive than what you said. If you're buying a stock that seems like an easy decision, it seems so easy that, oh, it must just go up, right? It seems obvious that it's going to go up. That's when you shouldn't buy it. So I would be careful. Look at the market now if you want to buy. And look, I'm not criticizing anybody for being bullish or wanting to buy right now or having a little bit of FOMO. I think none of us are immune to that, especially when you see rallies go on like this. But don't buy the stuff that seems easy to buy because that's usually the stuff that has already been bought by everybody else. Buy the stuff that seems a little bit more tricky to buy or something that feels risky because it hasn't participated, or maybe even something that's had a drawdown at the same time that some of this other stuff is going up for seemingly no reason.
Yeah, I'll just mention this, and we've highlighted this on the pod over the last 6 months or so on many occasions, this GLP-1, these obesity drugs. So it's Eli Lilly and it's Novo Nordisk. I mean, today, these are mega trends. People are excited about them as they are about AI, right? And we've seen people pile into them. I think they have a combined market cap of over $1.2 trillion right now. Both of these stocks gapped today to a new all-time high. Both of these stocks are up 3%. So you're seeing this sort of euphoric behavior, go on. And listen, can it go on longer than we expect, longer than we can rant on a podcast or on a television show on CNBC? I just think it's important to actually make people aware of this. This has happened before. We've seen it happen before. Very few folks, take advantage of it. Guy, take us out here, bud. Any parting thoughts? Because we're going to be on Market Call all week, Monday through Thursday. Liz, you'll be back with us on Wednesday. We're going to be doing the pod with Danny Thursday afternoon. That'll drop on Friday. Listen, we show up every day. We call it the way we see it. But this feels a bit unnatural to me, Guy, at the moment.
Yeah, look, I mean, you mentioned, I think Eli Lilly's pushing up towards $700. I mean, all the, to your point, all these things are seemingly on autopilot and it works until it doesn't. But when they pull the chairs out, and again, there are a lot of things to like right now. I mean, the market is the one thing, but there are a lot of things below the surface I think you have to be concerned about. And euphoria now and sort of I want to say the complacency out there amongst people is frightening in a word, because, we didn't even mention the fact that on Friday after the close, obviously the United States targeted 85 different places in terms of missiles and stuff. So, that we would have led with that historically, and we're not even talking about it today. So a lot out there to be worried about. Markets suggest otherwise, Dan.
All right, Liz Young, we really appreciate you being here bright and early with us on a Monday morning. Guys, stick around. Liz had a great conversation. It was a masterclass in moderating a panel, I will say. She had Mike Wilson and David Zervos. That was just last Tuesday, so stick around for that conversation. And Liz will be back with us on the Market Call on Wednesday afternoon. Guy and I will be back today at 1 o'clock on Market Call, 5 o'clock on CNBC's Fast Money. So tune in for all that. We'll see you all back on the Risk Reversal Media Network.